If you observe carefully what's happening in global bond markets, you'll notice something unprecedented. China has reduced its holdings of U.S. Treasury securities by $847 billion from the peak. Japan, America's largest foreign creditor for over a decade, has quietly sold off hundreds of billions as well. These aren't portfolio adjustments. These are strategic repositioning moves by the world's largest creditor nations. When your two biggest lenders start dumping your debt systematically, it's not a market event. It's a geopolitical earthquake. And if you understand what's really driving this behavior, you'll recognize that your retirement savings are sitting directly on the fault line. I've spent more than 4 decades studying currency systems, sovereign debt dynamics, and the behavioral patterns of nations under financial stress, from the British pound's loss of reserve status after World War II to the Plaza Accord of 1985, from the Asian currency crisis to the European debt crisis. When you understand incentives, you understand behavior. And right now, the incentives driving China, Japan, and dozens of other nations are screaming the same message. The era of automatic recycling of trade surpluses into U.S. Treasury bonds is ending. Consider the specific data. China's holdings of U.S. Treasuries peaked at approximately $1.32 trillion in 2013. Today, they hold roughly $775 billion, a reduction of $545 billion. But total divestment, including agency debt, approaches $847 billion. Japan's holdings peaked at $1.3 trillion in 2021 and have declined to approximately $1.1 trillion. A $200 billion reduction. These two nations alone have reduced U.S. debt holdings by over $1 trillion. But look at what they're buying instead. China's central bank has purchased over 1,000 tons of gold since 2022, increasing reserves by more than 50%. They're stockpiling commodities, building strategic petroleum reserves, investing in Belt and Road infrastructure, and creating bilateral trade agreements that bypass the dollar entirely. The pattern is unmistakable. The automatic recycling of global trade surpluses into U.S. debt is breaking down. 4 fundamental factors have changed the calculation for creditor nations. First, the weaponization of the dollar through sanctions created existential risk. When Russian dollar reserves were frozen in 2022, every finance minister in Beijing, Delhi, Riyadh, and Brasilia took notes. If the U.S. can freeze Russian assets for political reasons, no foreign reserve is truly safe. Second, U.S. fiscal dynamics have deteriorated beyond any reasonable path to sustainability. Annual deficits exceed $2 trillion during economic expansion. Total debt surpasses $38 trillion with no signs of stabilizing. Third, the Federal Reserve's policy creates impossible choices: accept negative real returns on treasuries or watch currency appreciation destroy export competitiveness. Fourth, geopolitical alignment has fractured, with China viewing America as a strategic competitor rather than an economic partner. History is an excellent teacher about what happens when creditor nations lose confidence. The British pound sterling was the world's reserve currency for over a century. After World War II, debts were unsustainable. Foreign creditors began reducing sterling holdings. The pound's share of global reserves declined from over 60% in 1945 to less than 10% by 1970. This wasn't sudden collapse. It was gradual, then accelerating, loss of confidence that took a generation, but created devastating consequences for British savers holding sterling-denominated assets. The 1970s provide another crucial lesson. After Nixon closed the gold window in August 1971, effectively defaulting on the dollar's convertibility promise, inflation reached double digits. The dollar lost over 60% of purchasing power. Foreign creditors holding dollar bonds were devastated. Domestic savers who trusted Treasury bonds as risk-free watched retirement savings evaporate in real terms. Gold increased from $35 to $850 per ounce. The economic chaos lasted a decade before Volcker's extreme interest rate hikes in the early 1980s finally restored confidence at the cost of deep recession. Let me tell you a story about 2 American families. In 2010, David and Carol Peterson, both 50, had saved $700,000 for retirement. David worked in manufacturing, Carol in healthcare. Their financial advisor constructed a conventional portfolio: 55% U.S. stocks, 35% U.S. bonds, 10% cash. The advisor explained that Treasury bonds were safe, backed by the full faith and credit of the U.S. government. The Petersons felt secure. Robert and Maria Chen, the Petersons' neighbors, were also 50 in 2010 with $700,000 saved. Robert worked at the same plant as David. Maria worked with Carol at the hospital. But the Chens had different perspective. Maria's parents had emigrated from Taiwan in the 1970s and told stories about watching the dollar's value fluctuate wildly during that decade. Robert understood that $14 trillion in government debt with trillion-dollar deficits couldn't end well. They positioned more defensively. 35% U.S. dividend stocks with international revenue, 20% international stocks, 15% tips and short-duration bonds, 15% precious metals, 10% commodities and real assets, 5% cash. From 2010 to 2014, the Petersons' conventional allocation performed well. Their portfolio grew to approximately $920,000. They felt validated. The Chen's portfolio grew to $880,000, slightly behind. They felt moments of doubt, maybe they were too cautious. But starting in 2014, divergence accelerated. The Petersons' bond allocation, heavily weighted to longer duration treasuries, began experiencing price declines. By 2018, their portfolio stood at $1 million nominally, but real value was deteriorating. Healthcare costs had doubled, property taxes up 40%. Everything was more expensive than official statistics suggested. The Chens experienced different dynamics. Their international exposure captured Asian growth. Their tips adjusted for inflation. Their precious metals, which had seemed like dead weight, started appreciating as central banks increased gold purchases and China began de-dollarization. By 2018, their portfolio reached $1.4 million, positioned for dollar weakness rather than dollar strength. Then 2020 arrived. The Federal Reserve created $4 trillion in new money. Congress passed over $5 trillion in deficit spending. The Petersons watched their portfolio swing wildly, ending 2020 at approximately $1.3 million. They were relieved, but they didn't recognize what had changed. They were holding massive amounts of dollar-denominated bonds when the incentive to inflate away debt had intensified dramatically. The Chen's portfolio surged to $2.1 million by late 2020. Their precious metals allocation tripled. Gold went from $1,200 to $2,000. Their international stocks recovered faster. Their commodities captured building inflation. They understood what was happening. The massive money creation, the weaponization of the dollar, the acceleration of Chinese de-dollarization. These were structural breaks in how the global financial system operated. From 2021 to 2024, consequences became impossible to ignore. The Petersons, now in their early 60s, watched inflation erode their bond values and purchasing power. Interest rates rose to combat inflation, meaning their long-duration bonds lost 20 to 30% of value. Their portfolio nominally stood at $2 million by late 2024, but in real purchasing power terms, accounting for cumulative inflation of 20 to 25%, their $1.2 million could buy what $960,000 could buy in 2020. They had gone backward. David mentioned they might need to work until 67 or 68 instead of retiring at 65. Carol started looking at part-time jobs to supplement Social Security. The Chens had a dramatically different experience. Their portfolio reached $2.8 million by late 2024. The precious metals allocation that friends had mocked provided the protection they designed it for. When everyone else panicked about inflation, they had assets that benefited from inflation. When dollar confidence eroded, they had non-dollar assets. When treasury bonds lost value, they had tips that adjusted. They weren't geniuses or lucky. They had simply understood one critical truth. When the world's largest creditors start dumping your country's debt, you probably shouldn't be holding that debt either. The difference came down to a simple question each family answered differently in 2010. Whose judgment do you trust more? Your government's assurances that everything is fine, or the revealed preferences of the world's largest creditors who are quietly heading for the exits? To understand this transformation, grasp three fundamental principles. First, reserve currency status is a privilege, not a right, maintained through confidence, not force. The dollar's dominance rests on foreign nations' willingness to accumulate dollar-denominated assets. That willingness depends on confidence in American political stability, economic strength, and monetary discipline. Once confidence erodes beyond a critical threshold, no amount of military power can maintain reserve status. Britain learned this with nuclear weapons and the world's second largest economy, but watched the pound lose reserve status anyway. Second, currency transitions happen gradually until they happen suddenly. The pound didn't lose reserve status overnight. The transition took decades, from roughly 1914 through the 1970s. But within that gradual decline were moments of acceleration. 1931, when Britain abandoned gold standard. 1949, when the pound was devalued by 30%. 1967, devalued again. For most of those decades, British citizens could convince themselves the pound remained strong. They weren't entirely wrong. Day to day, month to month, the pound functioned normally. But the long-term trajectory was unmistakable, and those who positioned defensively preserved wealth, while those who maintained faith in sterling's permanence watched purchasing power evaporate. We're currently in the gradual phase of dollar de-dollarization. Trade flows predominantly settle in dollars. Most commodities are dollar-priced. Central bank reserves remain majority dollar-denominated. The system functions. But the trend is clear. Dollar share of global reserves has declined from 72% in 2000 to approximately 58% today. Third, nations with large dollar debts benefit from dollar weakness while creditors suffer. The United States benefits from moderate dollar weakness because it reduces the real burden of our $38 trillion debt. We borrowed strong dollars and can repay with weaker dollars. But our creditors suffer. China and Japan hold dollar-denominated claims. If those dollars lose purchasing power, their claims are worth less in real terms. This explains their repositioning. They're not expecting imminent collapse. They're protecting against gradual erosion through inflation and strategic devaluation. If you're 58 with $800,000 in savings, currently allocated conventionally with 40% stocks and 40% bonds, you're betting against the same analysis driving China and Japan's repositioning. You're betting U.S. fiscal dynamics will improve, the dollar will remain strong, inflation will stay controlled, treasury bonds will preserve value. China and Japan are betting the opposite. The mathematics are sobering. If inflation averages 5% annually over the next decade, below 1970s peaks but consistent with sustained deficits and monetary accommodation, your $800,000 grows nominally to perhaps $1.3 million, assuming 5% portfolio returns. But that $1.3 million in purchasing power equals approximately $800,000 in today's dollars. You worked a decade, took market risk, and maintained purchasing power at best. More likely, given bond allocations will underperform in inflationary environments, you'll experience negative real returns. Consider practical implications. You're currently spending $65,000 annually in retirement. In 10 years, maintaining that lifestyle requires $106,000 annually at 5% inflation. Your Social Security of $32,000 might grow to $52,000 with COLA adjustments. But you'd need to withdraw $54,000 annually from your portfolio versus $33,000 today. Your withdrawal rate doubles. Your portfolio depletes in 18 to 20 years instead of 30-plus years. Based on these principles and clear signals from the world's largest creditors, consider a portfolio acknowledging dollar de-dollarization, 30% in U.S. dividend stocks with genuine international revenue, companies earning significant cash flow from non-U.S. markets. Think technology with global markets, energy selling commodities globally, pharmaceuticals with worldwide sales. 20% in international stocks, split between developed markets like Europe and Japan and emerging markets including Asia. This provides geographic diversification and exposure to economies less dependent on dollar strength. Focus on low-expense ETFs covering broad international indexes. 15% in precious metals, 70% gold, 30% silver. Buy physical metals, not paper claims. Store partially at home in a quality safe, partially in allocated storage at reputable vaults. This is direct protection against dollar devaluation. 15% in Treasury inflation-protected securities with 5 to 10-year maturities, providing inflation-adjusted returns while maintaining some dollar exposure. These are vastly superior to conventional treasuries in inflationary environments. Your principal adjusts upward with CPI. 10% in commodities and real assets through ETFs tracking broad commodity indexes, infrastructure funds, or real estate with international exposure. These maintain value independent of any single currency's purchasing power. 5% in alternatives, including currencies other than the dollar. Consider euros, Swiss francs, or small allocations to Asian currencies through currency ETFs. This is direct currency diversification, acknowledging declining dollar dominance. 5% in cash for liquidity and opportunities, but recognize this explicitly accepts purchasing power loss for flexibility. What to avoid? Do not hold long-duration U.S. Treasury bonds. These are the exact assets China and Japan are dumping. If the world's most sophisticated creditors with better information than you have are selling, why are you buying? Do not assume U.S. stocks alone provide sufficient protection. They can struggle during dollar crises. Do not ignore international diversification. Geographic concentration in the declining reserve currency is massive, uncompensated risk. Implementation should follow a structured 12-month timeline. Months 1 to 2, assess current allocation precisely. Months 3 to 4, begin reducing long-duration Treasury exposure gradually, perhaps 25% per month. Move proceeds to TIPS and short-duration bonds initially. Months 5 to 7, build precious metals positions systematically, buying $20,000 to $30,000 per month if your target is 15% of $800,000. Months 8 to 9, establish international stock positions. Rebalance domestic stocks toward those with genuine international revenue. Months 10 to 11, add commodity and real asset exposure. Month 12, establish currency diversification and rebalance to final targets. Work with tax professionals on implementation. Selling positions with gains triggers tax consequences. Rebalancing IRA and 401k accounts has different implications than taxable accounts. Critical disclaimers. Nothing in this constitutes specific financial advice for your unique situation. I do not know your complete financial picture, time horizon, risk tolerance, tax situation, income needs, health status, or family obligations. What might be appropriate for a 55-year-old with 30 years of life expectancy could be completely wrong for a 70-year-old with health issues and immediate income needs. These allocations represent general principles based on observing sophisticated creditor nations' behavior, not specific recommendations. Before making significant changes, consult qualified financial professionals, a fiduciary advisor legally obligated to act in your interest, a tax professional who understands implications, and potentially a retirement specialist who can model long-term sustainability under various scenarios. Past geopolitical trends provide no guarantee of future outcomes. China and Japan could reverse course. The dollar could strengthen for reasons I haven't anticipated. Inflation could remain contained despite fiscal deficits. De-dollarization could proceed far more slowly than expected. I could be entirely wrong. Market participants with far more information could be wrong. Uncertainty is inherent in all financial decision-making. International investing carries specific risks. Currency volatility, political instability, different regulatory standards, liquidity constraints, higher costs. Precious metals can experience 40% drawdowns. Commodities are notoriously volatile. Emerging markets can collapse suddenly. These aren't reasons to avoid diversification entirely, but reasons to approach it thoughtfully with appropriate position sizing. Timing risk is substantial. If you implement these strategies and the dollar strengthens, if U.S. bonds outperform, if de-dollarization stalls, you will underperform conventional allocations potentially for years. You need psychological and financial resilience to maintain positioning. I could be completely wrong about the fundamental thesis. Perhaps U.S. fiscal discipline will return. Perhaps productivity gains will support dollar strength. Perhaps China and Japan are making strategic mistakes you shouldn't replicate. The future is uncertain. This information is for educational purposes, to help you think critically about what it means when your country's largest creditors systematically reduce exposure to your country's debt. You are solely responsible for your investment decisions and outcomes. View this as beginning your own research. Study reserve currency transitions. Read about Britain's experience. Understand how Bretton Woods' collapse affected savers. Learn the difference between nominal and real returns. Have informed discussions with advisors who understand monetary history, not just modern portfolio theory. Assess your psychological capacity for maintaining conviction when your portfolio underperforms friends' portfolios. If you'll panic when your international stocks lag US stocks for 2 years, or when precious metals drop 30% before ultimately protecting you, these strategies may cause more harm than good. The broader point is philosophical and strategic. We're witnessing a historic shift in the global monetary order. The largest creditor nations are voting with their actions, reducing exposure to dollar-denominated debt after decades of accumulation. They see the same fiscal deficits you can see, the same monetary expansion, the same geopolitical tensions, but they also see things you don't: confidential economic data, intelligence assessments, non-public negotiations. Their decision to reduce exposure isn't impulsive. It's strategic repositioning based on long-term analysis. The choice is yours. You can dismiss this as alarmist, maintain conventional allocations, and trust that everything will work out. Or you can recognize that when your largest creditors are heading for the exits, perhaps you should reconsider whether you want to be increasing exposure to what they're selling. We observe signals that aren't headline news but are deeply significant. We study monetary history to recognize patterns that repeat across centuries. We understand that nations facing unsustainable debts always choose politically expedient solutions over economically honest ones. And those solutions always involve transferring wealth from savers to debtors through currency debasement. China and Japan dumping US debt isn't a trade recommendation. It's a warning about the changing structure of the global financial system. Some will heed this warning and position defensively. Others will maintain faith that conventional wisdom remains valid despite changing circumstances. The difference between these groups will determine who preserves purchasing power and who watches retirement savings evaporate in real terms. History shows this pattern repeatedly. The only question is whether you'll learn from the world's most sophisticated creditors or ignore what their actions are telling you.